An AI company is the only business in history where revenue can grow 10 times in 2 years, sign up 900 million weekly users, and the bigger you get, the more money you lose. It is also the business where the most successful company in the industry, OpenAI, is on track to burn through more cash by 2029 than the entire Apollo program cost to put humans on the moon. By the end of this video, you will know exactly how that is possible, how an AI company actually makes money, why having the smartest model on the planet still is not enough, and why an AI company is not really the business most people think it is. Here is what most people miss when they say AI company. They are not talking about one business, they are talking about three. At the bottom is the infrastructure layer, the picks and shovels, Nvidia, Microsoft Azure, Amazon Web Services, Oracle, CoreWeave. Companies that sell the actual chips, the actual electricity, the actual buildings full of servers that run the math. In fiscal 2026, Nvidia did over $215 billion in revenue, gross margin 71%. They do not care which model wins. They get paid no matter who is training. In the middle is the foundation model layer. OpenAI, Anthropic, Google DeepMind, xAI, Meta's research arm. They train the giant models. They take the funding rounds. They burn the cash. They are also the names everyone knows when someone says AI. At the top is the application layer. Thousands of startups wrapping somebody else's API into a chatbot for lawyers, doctors, salespeople, recruiters, financial advisors. Most of them own no model. They are paying OpenAI or Anthropic on every single query, then trying to charge their customer just a little more. 3 layers, 3 completely different economic profiles. Only one of them is consistently profitable in 2026. And here is the part that should make you stop and think. The layer making the most money is the layer most people do not even think of as an AI company. Nvidia is not an AI company in the way the public imagines. Nvidia is a chip company that happens to make the only chip the AI industry knows how to use at scale. It is the gas station in a gold rush, and in fiscal 2026, this gas station collected more profit than every foundation model lab on Earth combined. Okay, so look at the names everyone knows. Where does the money actually come from at the foundation model layer? OpenAI hit $20 billion in annualized revenue at the end of 2025. By February 2026, that figure had climbed to roughly $25 billion. CFO Sarah Fryer confirmed the trajectory in a public blog post. $2 billion in 2023, $6 billion in 2024, more than $20 billion in 2025. Roughly 3 times growth every single year. Where does that money come from? 3 buckets, roughly. ChatGPT subscriptions, which is the $8, $20, and $200 a month plans, API access for developers and other companies, and enterprise contracts, the deals where a Fortune 500 company buys ChatGPT for 30,000 employees. Enterprise is moving toward parity with consumer by the end of 2026. The same pattern shows up at Anthropic, even more dramatically. Roughly 80% of Anthropic's revenue comes from business customers, not consumers. The company went from about $1 billion in run rate at the start of 2025 to over $30 billion in run rate by April 2026. Most of that growth is Claude Code, a coding assistant that hit $1 billion in run rate by November 2025 and $2.5 billion by February 2026. Faster product market fit than any enterprise software in history. So far, this looks like every other software company you have ever seen. Big subscription numbers, big enterprise contracts, big growth, big valuations. Anthropic raised at $380 billion. OpenAI's secondary shares trade close to $850 billion after its most recent funding round. The market is treating these companies as if they were the next Microsoft. Now here is the question that actually matters. If revenue is this big, where is the profit? The answer is that there is not any. OpenAI posted a $13.5 billion net loss in just the first half of 2025. Internal projections leaked to the information put 2026 losses between $14 and $17 billion against roughly $13 billion in sales. Total spending, around $22 billion. Cumulative cash burn by 2029, an estimated $115 billion. The entire Apollo program cost about $288 billion in today's money over 13 years. OpenAI is on pace to burn close to half of that in 6 years. Anthropic does not disclose the same level of detail, but its compute and talent costs scale with revenue, and the company has recently signed multi-gigawatt compute deals to keep up with demand. That is not the spending pattern of a profitable business. xAI is reportedly burning around $1 billion a month while generating very little revenue. Across the industry, one analysis estimated that for every dollar of AI revenue, the major labs are losing close to $40 on the infrastructure required to serve it. Stay with me, because this is where the story stops looking like Microsoft and starts looking like something else. Step back for a second. You have 3 companies sitting on the largest pile of user attention in human history. 900 million weekly active users at ChatGPT alone. More than 300,000 business customers at Anthropic, revenue growing faster than any software business ever recorded. And the bigger they get, the more they lose. That is not a normal software business. A normal software business gets cheaper to run per user as it scales. AI does the opposite. Every new user costs more, not less. Every new feature costs more, not less. The bigger you get, the deeper the hole you have to dig out of. To understand why, you have to look at the layer underneath, where the actual money is going. Okay, so that is the revenue. Now the architecture. When a customer types a query into ChatGPT, the model runs on a cluster of Nvidia GPUs. Each query has a cost: compute, electricity, depreciation of the chips, cooling, networking, the engineers babysitting the cluster. Every single one of those is a real dollar that has to be paid. This is what makes an AI company different from every other software company in history. When you buy Microsoft Word, Microsoft does not pay anything extra when you type a sentence. When you watch a Netflix show, Netflix pays a fixed bandwidth cost no matter how many people watch. When you scroll Instagram, the per-user cost is fractions of a penny. When you ask ChatGPT a question, OpenAI pays for it every single time. Here is the way to think about it. Every conversation with a frontier AI model is more like a meal prepared to order than a song streamed from a server. Streaming a song costs almost nothing extra per listener. Cooking a meal costs ingredients, time, heat, labor. Generative AI works the same way. Serving one more user is genuinely more expensive than serving the last one. An AI company is not a software company. It is an electricity company with a chatbot on top. For traditional software, infrastructure is about 5 to 10% of revenue. For an AI company, compute can eat 30 to 50%. For some foundation model companies, that number goes above 60%. Industry estimates put OpenAI's GPU spending at roughly 40% of revenue. By comparison, Google spends around 15% of revenue on its entire infrastructure. So every additional user is not a free addition to the spreadsheet. Every additional user has a marginal cost, and the more popular the product gets, the more marginal cost you stack on yourself. Now, the obvious counter is that compute is getting cheaper, and that is true. The cost per million tokens for a top-tier model dropped from around $30 in early 2024 to under $5 by 2026. Some newer models go further, a roughly 1,000 times reduction in inference cost across 3 years. The catch is this: you used to pay 10 cents to ask the model one question. Now you pay 2 cents. So you send 50 questions instead of 5. Your bill did not go down. Your bill went up 5 times. Multiply that by 900 million weekly users, and the math gets brutal. Economists have a name for this: the Jevons Paradox. When something gets cheaper, total consumption rises faster than the price falls. Steam engines got more efficient and coal use exploded. Lighting got cheaper and total electricity demand multiplied. AI inference is getting cheaper. Total inference spending is going up, not down. So the math floor underneath an AI company is brutally simple. The compute bill is bulletproof. Everything you build on top of it is not. Pay attention to this, because it is the single most important rule of the industry. You are not really selling intelligence, you are selling prepaid electricity bills. And every customer who loves the product, who uses it 10 times more this year than last year, is a customer who is making your electricity bill 10 times worse. There is a second piece of this floor that does not get discussed enough: talent. The labs are in a bidding war for the same few hundred researchers. OpenAI and Anthropic have stabilized senior engineer total compensation around $350,000 to $550,000. Top researchers at OpenAI reportedly earn more than $10 million a year. Meta has offered signing bonuses of $100 million to lure senior people. In one notable deal, Meta paid $14.5 billion for Scale AI in what was widely seen as a very expensive way to hire one CEO. The engineers cost more every year, the chips cost more every year, the electricity costs more every year, and the price your customer is willing to pay keeps falling because 3 other companies are racing to offer the same thing cheaper. That is the floor every AI company is standing on. Okay, so the big labs at least have giant cash piles to absorb the losses. What about everyone else? This is where it gets stranger. The application layer, the thousands of startups wrapping OpenAI or Anthropic in a friendly interface, has the worst structural position in the entire stack. And the case study for what happens to a wrapper company that gets it wrong is named Jasper. Jasper was once called the poster child of AI native SaaS, an AI writing assistant built on top of OpenAI. Founded in 2021, by the end of 2022, the company hit $80 million in annual recurring revenue, growing nearly 2 times year over year. Investors valued the company at $1.5 billion. The founders told the board they would hit $250 million in ARR by the end of 2024. The trajectory looked unstoppable. Then ChatGPT launched in November 2022, and the same model Jasper was renting from OpenAI was now available for free directly to Jasper's customers. By the summer of 2023, Jasper had revised its forecast down by at least 30% and laid off a chunk of its team. Internal valuation cut by 20%. Both co-founders were out by September of that year. Revenue hit $120 million in 2023, then collapsed to $55 million in 2024. A 54% revenue drop in 1 year against an original projection of $250 million. The product did not get worse. The market did not shrink. The model Jasper was paying for got cheaper, faster, and free in the place where its customers already lived. The kitchen Jasper was renting did not get more expensive. The restaurant next door started giving away the same food for free. The second case is even worse, and it is not technically an AI company at all. It is Chegg. Chegg was an online tutoring and homework help platform. At its peak in February 2021, the company was worth roughly $14 billion, 7.8 million paying subscribers, annual revenue of $776 million. The Wall Street consensus called it the dominant edtech company in America. After ChatGPT launched, students could get instant homework help for free. Chegg's stock dropped 49% in a single day in May 2023. By November 2024, the market cap had fallen to $191 million, from $14 billion to $191 million, a 98% collapse in less than 4 years. Here is the part that haunts every AI company in the wrapper economy. Chegg tried to fight back. In April 2023, Chegg launched a product called Cheggmate in partnership with OpenAI itself. The idea was simple. If students were going to use ChatGPT anyway, Chegg would integrate ChatGPT into a paid product. The partnership with OpenAI was the entire defense strategy. Cheggmate failed. Students who already had access to ChatGPT had no reason to pay Chegg for a wrapper around the same model. By 2025, revenue had fallen to around $290 million. The company laid off 22% of staff in May 2025, then 45% more in October. Total workforce cut, roughly 2/3 in 6 months. These two failure patterns represent the two existential risks in the AI economy. 1. You build on top of a model you do not control, at pricing you did not set, competing with the model itself. 2. You own something valuable that a foundation model can replicate for free, and a partnership with the very lab that is replacing you will not save you. Industry data from CB Insights and others suggests roughly 14,000 AI startups launched globally in 2024. Around 3,800 shut down in 2025. Another 1,800 closed in early 2026. That is a failure rate of roughly 40% in 24 months and rising. AI startups are dying about twice as fast as their non-AI counterparts. And here is what nobody at the Foundation Labs likes to say out loud. The wrapper economy is what props them up in the first place. Every freemium user of every AI app is sending tokens to OpenAI or Anthropic. The wrapper is paying for that traffic out of investor money. If the wrapper dies, the Foundation Lab does not just lose a customer, it loses a piece of the distribution that makes its numbers look as big as they do. Now back to the Foundation Labs themselves. They have one defense the wrappers do not: scale. They can afford the talent. They can afford the compute. They can absorb losses for years because investors keep writing larger checks. But there is a quieter problem at this layer too: pricing power. In early 2024, top-tier model inference was roughly $30 per million tokens. By 2026, the equivalent capability is under $5. Some competing models are below $1. DeepSeek released models in 2024 and 2025 that were nearly free to use. Open-source alternatives like Llama and Qwen close the gap on quality every few months. So OpenAI and Anthropic have to keep training new frontier models, which cost more each generation, to stay ahead of a wave that is making their existing models worth less every 12 months. Per dollar wagered, the picks and shovels seller is statistically the only one in the room making real profit. Everyone else is digging. And yet, the digging continues. Why? 3 reasons, none of them comfortable. First, the bet on AGI. If any one of these labs builds a model that can do most cognitive work a human can do, the economic prize is not measured in billions, it is measured in trillions. Sam Altman has publicly said OpenAI expects to spend trillions on infrastructure to chase it. If the chance of success is 5% and the prize is $10 trillion, the expected value of burning $100 billion is still positive. That is the math investors are doing in their heads when they write the next check. Second, race dynamics. If OpenAI stops burning to become profitable, Anthropic catches up. If Anthropic stops, xAI catches up. If xAI stops, Google catches up. The moment any single lab pulls back, the other labs absorb its talent, its enterprise customers, its market share. There is no equilibrium where everyone slows down at once, so everyone runs at the same brutal pace, knowing that pace is unsustainable because the alternative is losing entirely. Third, the scaling laws have not broken yet. Every time the industry has spent 10 times more on compute, the resulting models have measurably improved. As long as that relationship holds, the money is not being burned. It is buying capability. The day the curve flattens is the day the spending becomes irrational. Nobody knows when that day comes, so everyone keeps spending until it does. These 3 forces, stacked on top of each other, create the strangest market in technology history. A market where the players know the math is bad, know the failure rate is brutal, and run faster anyway. Time to pull it all together with 2 scenarios. Small AI startup. You raise $4 million. You build a wrapper around the Claude API for a vertical, say legal contract review. You hire 8 people. Average compensation in the Bay Area for engineers who can ship AI products, $250,000 a year. Headcount cost alone, $2 million per year. You sign up a few hundred small law firms at $100 per seat per month. You hit $500,000 in annual revenue. Your API bill is 40% of revenue. Your sales and marketing is another 30%. Customer support, infrastructure outside the model, legal, accounting, the rest is gone. You are spending roughly 4 times what you make. Your runway tells you that you have 14 months. You raise a bridge round. The terms are worse. You hit 24 months. You either find a real moat in that window, or your investors quietly write you off as a learning experience. That is the application layer in 2026. Now the foundation lab. You are OpenAI. You hit $20 billion in annualized revenue in 2025. You spend roughly $7 to $9 billion of that on compute. You spend $2.5 billion or more on people. You spend several billion on research and operations. You lose somewhere between $13 and $15 billion for the year. But you also raise funding rounds at $300 billion, then $500 billion, then close to $900 billion. You sign $250 billion in cloud contracts with Microsoft, about $300 billion with Oracle over 5 years, $38 billion with Amazon over 7 years. Your balance sheet looks like the GDP of a small country, except most of it is committed spending, not assets. You are not running a company. You are running a giant bet. The bet is that if you keep absorbing losses long enough, someday the model becomes valuable enough, or cheap enough, or useful enough to throw off real cash. And before that day arrives, you need to outlast every other lab burning at the same rate. Now go back to the layer underneath. Nvidia, fiscal 2026, $215 billion in revenue, 71% gross margin, $193 billion of that revenue from data center alone. While OpenAI and Anthropic and xAI and Meta and Google are losing money to train and serve models, Nvidia is collecting the toll on every single query, every single training run, every single moment of compute spent in the entire industry. Sequoia Capital noted in one analysis that the industry spent about $50 billion on Nvidia GPUs in 2023, and that generated about $3 billion of total AI revenue, $16 of shovels for every $1 of gold. So when someone asks what an AI company actually is, here is the honest answer. If you own the application layer, you own a thin interface on top of someone else's intelligence, racing against 3 competitors to convert freemium users before your cash runs out. Ask Jasper how that ends. If you own a business adjacent to the foundation labs, you own something that can be replicated for free by the model your customers already use. Ask Chegg how that ends. If you own the foundation model itself, you own the smartest software ever built, and you are losing the most money any technology company has ever lost in history, betting that someday, somehow, the curve bends. If you own the picks and shovels, the chips, the data centers, the electricity, you own the part of the entire industry that has not moved. Nvidia did not start as an AI company. It started in 1993 making graphics cards for video games. By 2026, almost every dollar of AI revenue on Earth passes through one of its chips first. You think about the layers again. The wrapper company burns to fuel the foundation lab. The foundation lab burns to train the model. The training runs on chips. The chips run on electricity. The electricity has a price. And the company at the top of that chain, the one everyone is paying, is the one that simply sells access. Jensen Huang, the CEO of Nvidia, has called the AI build-out the largest infrastructure expansion in human history. He is correct, and he is the one collecting the rent on most of it. The house always wins. In the AI casino, the house is wearing a leather jacket and selling GPUs. Thank you for watching.